When it comes to securing your financial future, few decisions are as critical as choosing the right investments. The choices you make today can have a profound impact on your financial well-being for years, even decades to come. It's not just about growing your wealth, it's about ensuring stability and peace of mind. Two contenders often top the list: real estate and the stock market. These two investment avenues have been the subject of countless debates among financial experts and everyday investors alike. Both offer the potential for significant returns, but they come with distinct characteristics and considerations. Real estate, with its tangible assets, provides a sense of security and long-term appreciation. On the other hand, the stock market offers liquidity and the potential for rapid growth. Understanding the nuances of each is paramount. Real estate investments often require substantial capital upfront and can involve ongoing maintenance costs. Stocks, while more accessible, can be volatile and subject to market fluctuations. This is about more than just numbers on a spreadsheet. It's about aligning your investments with your personal values and life goals. Whether you're looking to build a nest egg for retirement, save for your children's education, or simply achieve financial independence, the right investment strategy is crucial. It's about your dreams, your security, and your future. Real estate can offer a sense of permanence and stability, while stocks can provide the flexibility to adapt to changing financial landscapes. This video delves into the intricacies of real estate and the stock market, particularly focusing on the S&P 500. The S&P 500, a benchmark of the U.S. stock market, represents a diverse range of industries and has historically provided strong returns. We'll explore the pros and cons, compare their strengths and weaknesses, and equip you with the knowledge to make informed investment decisions. From understanding market trends to evaluating risk factors, we'll cover all the essential aspects. Ultimately, the better investment is the one that aligns with your individual financial goals, risk tolerance, and investment horizon. Let's dive in and uncover the best path to securing your financial future. Real estate has long held a certain allure for investors. Unlike stocks, which exist as digital entries, real estate represents something tangible. You can see it, touch it, and even live in it. This tangibility often translates into a sense of security and control. It's a tangible asset that you own, a piece of the earth that you can build on, rent out, or pass down to future generations. Beyond its psychological appeal, real estate boasts several compelling financial advantages. One of the most significant is its potential for appreciation. Historically, real estate values have tended to increase over time, often outpacing inflation. This appreciation potential makes real estate an attractive option for building long-term wealth. Let's explore those benefits further. Owning real estate allows you to build equity with every mortgage payment. Instead of throwing money away on rent, you're gradually paying down your loan and increasing your ownership stake in the property. This forced savings mechanism can be a powerful tool for wealth accumulation. Moreover, real estate comes with a slew of tax advantages. Mortgage interest and property taxes are often deductible, reducing your taxable income and potentially saving you thousands of dollars each year. Additionally, you can defer capital gains taxes through strategies like 1031 exchanges, allowing you to reinvest profits into new properties without immediately triggering a tax liability. These tax benefits can significantly enhance the overall return on your real estate investment. However, we need to address the elephant in the room: interest rates. While real estate offers compelling advantages, it's not without its challenges. One of the most significant factors influencing the real estate market is interest rates. Higher interest rates translate into larger monthly mortgage payments, making homes less affordable for buyers and potentially slowing down the market. Conversely, lower interest rates can stimulate demand, driving up prices, and creating a more competitive market. As of 2024, we're seeing a trend of rising interest rates, which is something to keep a close eye on. Another consideration is the cyclical nature of the real estate market. Like any market, real estate goes through periods of growth and contraction. It's essential to be aware of these cycles and avoid making impulsive decisions based on short-term market fluctuations. Section 5 S&P 500, riding the waves of the market. Now, let's shift our attention to the stock market, specifically the S&P 500. This index is one of the most well-known and widely followed benchmarks in the world of finance. The S&P 500 is a stock market index that tracks the performance of 500 large companies listed on stock exchanges in the United States. These companies represent a broad cross-section of the economy, from technology giants to healthcare leaders, and everything in between. Investing in the S&P 500 offers a level of diversification that's difficult to achieve with individual stocks. By holding a single investment in this index, you gain exposure to a wide array of sectors and industries, which can help balance your portfolio. When you invest in the S&P 500, you're essentially buying a small ownership stake in hundreds of companies spanning various industries. This means that your investment is not tied to the fortunes of a single company or sector, but rather the collective performance of many. This diversification helps mitigate risk by spreading your investments across a broad spectrum of assets. For example, if the technology sector experiences a downturn, gains in other sectors like healthcare or consumer goods can help offset those losses. If one sector or company underperforms, others can potentially offset those losses. This balancing act is one of the key advantages of investing in a diversified index like the S&P 500. But the stock market, even with diversification, is not without its own set of risks and rewards. Market volatility can lead to significant fluctuations in the value of your investments. It's important to understand that while diversification can reduce risk, it cannot eliminate it entirely. Over the long term, however, the S&P 500 has historically provided solid returns, making it a popular choice for investors looking to build wealth over time. Patience and a long-term perspective are crucial when riding the waves of the market. By staying informed and maintaining a diversified portfolio, you can navigate the ups and downs of the market with greater confidence. Remember, investing is a journey, and the S&P 500 can be a valuable part of that journey. Section 6S and P 500, Historical Performance and Dollar Cost Averaging. One of the most compelling arguments for investing in the S&P 500 is its historical performance. The S&P 500, which tracks the performance of 500 of the largest companies listed on stock exchanges in the United States, has a long history of delivering strong returns. Over the long term, the S&P 500 has consistently trended upwards, delivering impressive returns for investors who stay the course. This means that those who have invested in the S&P 500 over a long period have generally seen their investments grow significantly. However, it's crucial to remember that past performance is not indicative of future results. While the historical data is encouraging, it does not guarantee future performance. The stock market is inherently volatile, and there will always be periods of ups and downs. Market corrections and bear markets are inevitable, and they can be unsettling for investors. This is where dollar cost averaging comes into play. Dollar cost averaging is a strategy that can help mitigate the risks associated with market volatility. Dollar cost averaging is an investment strategy that involves investing a fixed amount of money at regular intervals, regardless of the market's current price. By doing so, you spread out your investments over time, which can help smooth out the effects of market fluctuations. This approach helps reduce the impact of market volatility by ensuring that you buy more shares when prices are low and fewer shares when prices are high. Over time, this can lead to a lower average cost per share, which can enhance your overall returns. Additionally, dollar cost averaging can help take the emotion out of investing, as it encourages a disciplined approach to investing, regardless of market conditions. This can be particularly beneficial during periods of market turbulence, as it helps investors stay focused on their long-term goals rather than reacting to short-term market movements. Section 7S and P 500, Diversification and Long-Term Growth. As mentioned earlier, diversification is a key advantage of investing in the S&P 500. By holding a basket of stocks across various sectors, you're less exposed to the risks associated with any single company or industry. This diversified approach can help smooth out returns over the long term and potentially enhance your overall portfolio growth. Investing in the stock market, particularly through index funds like the S&P 500, often incurs lower fees compared to actively managed funds. These lower fees can make a significant difference in your net returns over time. Remember, the name of the game is long-term growth. It's about riding out the market's inevitable fluctuations and staying focused on your financial goals. Section 8, Head-to-Head Factors to Consider. So, which is the better investment, real estate or the S&P 500? The answer, as with most things in personal finance, is, it depends. Real estate offers tangible assets, potential tax advantages, and the psychological comfort of owning a physical property. It can be an excellent option for those seeking to build equity, generate rental income, or simply have a place to call their own. The S&P 500, on the other hand, provides diversification, historical growth potential, and a relatively hands-off investment approach. It's well suited for investors seeking long-term growth and those comfortable with a certain level of market volatility. Ultimately, the best choice for you depends on your individual circumstances, financial goals, risk tolerance, and investment horizon. Section 9. Paving your unique path to financial success. There's no one-size-fits-all answer when it comes to investing. Real estate and the S&P 500 each offer unique advantages and considerations. The key is to carefully weigh your options, assess your financial situation, and choose the investment path that aligns best with your goals. Remember to do your research, seek advice from qualified financial professionals, and never invest more than you can afford to lose. Investing is a journey, not a sprint. By making informed decisions and staying disciplined, you can pave your own path to financial success.